Treasury yields saw a big move lower today, especially when you account for what happened overnight. 10-year note yields got as high as just north of 170 overnight, and then they came crashing down on this morning's ISM manufacturing data, which came in consecutive months below 50 for the first time since Jan and Feb of 2016. The market really kind of starts to reprice things now, because when you talk about expectations and you talk about trade deals with China or what's going on in Europe or Washington, D.C. politics, those are all expectations and what-if scenarios. When you get hard data like we got today, it says manufacturing is not only slowing, it's slowing in consecutive months, things start to change a little bit. So we see a reversal in yields. We got as low as 161 today. So about a 14, 15 basis point yield range in the session, which really shook things up a little bit. And I think ultimately right now, the market is gearing towards, again, being more prepared for yields to go lower than maybe say we were maybe a week ago or so. We were looking for yields to maybe creep back higher towards 180. So at this point, yields right now are not trending lower, but look to be forcing and nudging their way there. So as you can expect, volatility was higher on the big move lower. Obviously, things cooled down as the end of the session, but volatility remains elevated. Given the fact that we fluctuated so much in one session, created a little bit of panic buying and covering. So I think at this point, shorts were getting out. Anyone who was short vol, anyone who was short treasuries, they were looking to get out, at least in the short term here, with the idea that this may have some legs. One number doesn't make a trend, but again, seeing the ISM numbers for 2 months in a row below 50 has to create concern and will give the Fed something to think about with their next upcoming meeting on October 31st. And lastly, let's look about what's going to happen next here. Obviously, the Fed remains in play. Are they going to cut 25 basis points in October FOMC? The market sees about a 70% probability as of now that is going to happen. So that things have changed. Just a day or two ago, we were looking at maybe 40 to 50% odds. Now we're well above 70. That is going to be a concern for the Fed going forward if they wanted to wait until December. And what about employment on Friday? Well, employment really hasn't been the problem in this entire recovery through the Obama and Trump presidency shift. It hasn't been an employment problem. But if employment does become an issue, that will only create momentum to even lower yields. That would create sort of a panic buying, a flight to quality bid, whatever you want to call it, that would continue and push us towards new and lower yields. So at this point, employment could be key. Even if it remains strong, it's key because it at least shows that one sector isn't showing weakness, isn't proving that the Fed needs to cut more aggressively. And right now, the Fed wants to wait. They want to be patient. But these Treasury yields creeping towards 160 and possibly back towards 150 will create the sort of the scenario that the Fed is going to have to be more aggressive. They are going to have to raise or cut rates more aggressively than they wanted to. And that means a 25 basis point cut at the end of the month, with the possibility and likelihood of another one in December. So as we head into employment, remember, a strong number doesn't mean isn't a yawner. A weak number would create some panic, but a strong number means that maybe one sector is strong and the Fed can be patient. We'll have to wait and see.